How much further do markets have to fall? Well, in this video, we are going to go through two potential scenarios. One scenario is an estimate of what happens in years that are as bad as they have been thus far in 2022, and what kind of returns would we expect for the next year after the sort of pain that we've been through. Then we're going to go ahead and look at a Citibank analysis in terms of what three potential scenarios we could run into in terms of market returns and what to do in each of those scenarios. Let's get right into that. Note, this video is brought to you by StreamYard. If you watched any of my Tesla live streams yesterday, or you like my Federal Reserve or CPI or jobs live streams, they are brought to you by StreamYard. I stream through StreamYard. I can multi-stream. I pin comments up on screen, and honestly, it works all the time. And if you want to learn more, go to meetkevin.com/StreamYard in terms of how you can sign up. Absolutely love the streaming software. Okay, folks. First, let's look at the S&P 500. The S&P 500 has had its worst year in over 50 years when we count the number of green days there have been. There have not been a lot of green days. As a result, there have been a lot of opportunities to follow the psychology of money and buy on red. Unfortunately, just buying the dip has turned into riding the fallen knife down. Well, folks, could that potentially be setting your portfolio up for green for next year? Let's take a look at this report and then we'll get into the Citi report. Take a look at this chart here. Years with fewer up days than red days tend to precede years with above average returns. So in other words, in English, when we have these nasty years where positive days are less than 50%, look at what we have here. Positive days are anywhere between 42 to about 45%. Anytime we have those sorts of years, we tend to see S&P returns which are vastly negative. And this makes sense, right? This year we're at 43.5% positive days, and if you look at the return for this year, we're at about negative 22%. When you compare that to the average or the median, you'll see that on average, we're actually down negative 19.7%. So we're down a little bit more than average. And on the median, we're down 17.9%. So by the middle, we're also a little bit exceeding the middle here. Now, the number of positive periods here has really been once. We've had one positive year, and that was 1982, which is a little bit of a unique year because in 1982 was right sort of at the peak of the Paul Volcker transition, where Paul Volcker's policies were starting to work. So you went from having like the worst stock market crash in year to a pivot. Ooh, how nice that would be, to basically a large stock market rally towards the end of the year. But outside of that, every single year we have had less positive days than red days has led to a red S&P 500. And not by a little bit. I mean, we're talking about having just maybe 6% fewer green days than red days. And that's led to an average of 19.7% declines. So, what typically happens the year after? And then let's get into those Citibank scenarios. By the way, remember, if you're an accredited investor, househack.com has a deadline coming up on October 31st for you to get the next most amount of call options, warrants. Read the PPM for details on how those work. And those come for free with your investment. All right, S&P returns the following year. Here you go. Look at this. On average, folks, after this sort of red, the 12 months thereafter return on average 12.5%. In the middle, or on the median, 17.3%. We're clearly green most of the time. In fact, we were only red twice. The times we were red were right at the beginning of sort of the inflationary disasters of 1973, right when we left the gold standard, and we had an oil war as well as price control issues. And once again, in 1931 after the Great Depression here. But otherwise, you've had relatively green years thereafter. So if there's any potential sign of hope, it's that, hey, the next 12 months, should be better than the last 12 months. Okay, good. A little hopium's always good. So what kind of scenarios do we have from Citibank? All right. In the Citibank baseline scenario, central banks continue to tighten policy through the end of the year and maintain their restrictive stance against inflation. At 6% globally, inflation, double the historic average, remaining uncomfortably high. The global economy, therefore, then continues to lose steam and slows materially as elevated inflation further eats into demand, which if you watched my housing video yesterday, you'll see that we have a massive issue with rental inflation that could last for another year and a half. However, remember, also, markets like to find a bottom 6 to 12 months before the bottom of the actual sort of economy, if you will. Anyway, as elevated inflation eats into demand and high policy rates and tighter financial conditions more broadly act to slow growth over the next 5 quarters, we see global growth in this scenario averaging around 2.25%, slightly below a 3% trend, but not abnormally low. Notably, we expect China's growth to accelerate to around 6% next year. Interesting. Excluding China's growth, global growth would be around 1%. So they really see China as an opportunity to provide for offsetting weakness elsewhere. And as a result of their forecast, they believe that global earnings per share, so in other words, on average, earnings per share across the board will contract by about 5%. Well, folks, so you can translate this. If you have a $100 stock today that's trading for a 10 times multiple with a 10 times earnings per share, then a 5% contraction would be a 5% decline in the stock price. That makes sense. To understand this a little bit more relatively, let's say your stock was $200 and it also had $10 of earnings, but it was trading for 20 times earnings. So phase 1 of a market crash is multiple compression. Phase 1 is right here. The 20x turns into 10x right here. And then phase 2 is earnings compression. Is how much further does it go down now? So in this case, Citibank is expecting an additional 5% set of pain being possible. In their hard scenario, they suggest that risk appetite and asset prices fall sharply at the end of the year. In other words, the worst could still be ahead of us. Central banks respond by providing liquidity. This is kind of like a United Kingdom disaster, almost suggesting that, asset prices are going to be very slow to recover here. We have liquidity issues. The Fed needs to bail out markets to ensure financial stability. People lose their jobs like Liz Truss lost hers. And as demand falls off and inflation pressures similarly come off the boil, most major economies fall into deep downturns. So this is sort of your nominal downturn scenario. This is your deep downturn scenario here at the bottom with a hard landing and growth near zero. They believe this synchronized global recession, on top of an impact on company profits, would lead to earnings declining by an additional 18%. And corporate earnings could actually decline by as much as 31%, if they were to align with typical recessions, like the last 3 major recessions that we've seen. So that means their estimate of a hard landing of negative 18% might not actually be as severe as the estimate really should be. And so in this sort of scenario, probably don't want to be in the market, but we'll talk about what you want to do in all these various different scenarios. But as you can see here, an 18% decline versus a 5% decline, relatively rough in the hard landing scenario. In the soft landing scenario, inflation for goods falls quickly by the end of the year. That means services could remain high, like, for example, owner's equivalent rents. And this would be consistent with what we're actually seeing in supply chains easing, container prices going from $20,000 a container to $3,500 a container, commodity prices falling like steel, aluminum, copper, lumber. But the surprise is that services spending also quickly falls. And so when services spending falls, you see some inflationary declines here. which could reiterate potentially a soft landing. That way, you have service spending moderating but not collapsing. And the demand for labor in the services sector brings the job market into balance. So maybe not necessarily unemployment skyrocketing, but rather job openings being balanced, having as many job openings as you have people willing and able to work. An added positive, the winter passes without another challenge of a new virus emerging. COVID, they can then maybe relax via its COVID-0 policies in China. And central banks begin to ease in 2023, much sooner than we currently expect. The result could be a rising of global EPS and basically a stock market rally. And they suggest that people who would benefit and that stocks that lead the way will be cyclical stocks like growth stocks and tech stocks, and investors hiding in more defensive stocks would miss out. So, how do we cast these three scenarios on a table together? Right here. The implied earnings per share change for the glorious scenario would be 0, but we'd have a stock market rally. Now, they don't particularly give us here how much we think we would see in terms of a rally, and this is where it's nice to go back to this S&P return chart and suggest probably somewhere around a middle between the average and the median there. Let's go with about 15.5% for a rally in this soft landing scenario. And in this rally scenario, you potentially want to chase the rallies and ultimately buy cyclicals that have sold off. Anything that moves with the business cycle. So anything that's been heavily sold off in this last recession could rebound nicely. Whereas things that have performed well, like defensives, like energy, healthcare, might not do as well. In the hard landing scenario, you want to sell every single dip. Just get out of the market, get into defensives, which honestly right now is just cash. Remember that 24% decline scenario. Citi's current view is that you should actually be buying the dips, that the S&P is potentially going to outperform, but in the near term, defensives will outperform cyclicals. And so if you want to just be an index-based investor, that would be a way to get sort of a diversified approach here. And there's nothing necessarily wrong with that. But this gives you a breakdown of 3 potential scenarios and some hopium for the S&P 500 going forward. Which scenario do you think is most likely? And have you gone to meetkevin.com/StreamYard?